about 50 feet away is red eyes. And so I could tell there's a shark, and the shark is essentially between the boat and us. And I look at my buddy, and I'm like, hey, I do the little symbol of, hey, there's a shark. And he's like, yeah, I see it. And then I look at my buddy, and he's got a bloody nose
Oh
because
my
he's just
gosh.
getting over a cold.
Blood in the water.
And when you come up, it releases the pressure because when you go down, each 30 feet is an atmosphere. So when you come up, it releases that. And so now all of a sudden the capillaries have released. He's got a bloody nose, and I'm like, oh my god, there's a shark. We don't know what kind of shark, and it's between essentially us and the boat, and my buddy's bleeding.
Welcome to the Time and Money Network. I'm Jason Couch, and I have been looking forward to this show since we booked it. The title of this show, Memoirs of a Secret Banker. And we're just going to call this gentleman in front of me Bob. Well, every banker should be known as a Bob, right? And what we're going to do is figure out, how do underwriters really think? How do banks view risk? How do we get loan packages that we don't get rejected all the time? Because I've personally struggled with this in my real estate career. And even though my credit score was phenomenal and my taxes were perfect and everything was the right package and the property was right and the risk was diversified, bankers would still come up with arbitrary no's. You need a document from 1983 because you made $200 and we need to source that income. Things like that become really frustrating, especially in real estate. But also if you're trying to get equipment loan, funding an expansion of a business, you need to know how banks think. So let's introduce Bob. And Bob, why don't you tell a little bit about your history in the banking world and where you come from?
Hi, thanks a lot, Jason. I appreciate you inviting me today. Yeah, I grew up in Houston. I'm a third generation banker. I've been banking for over 30 years. My grandfather started 5 banks. My dad was in real estate and development in the 70s and 80s, and then in the early 80s, he went to work for banks when all the S&Ls started struggling and the real estate debacle. And I picked it up in the 90s and went to school and got a finance degree, and then later on got an MBA with a focus of tax accounting and finance, so that I had all the necessary credentials so that when I went out and met with small business owners, I knew how to make the numbers work. But I'm kind of unique because in high school I did acting, and so I'm an extrovert, but I'm analytical. So I'm that salesperson that can back it up with numbers.
That's awesome.
So it served me well in the banking world that I get told all the time, stop selling. We got it. We understand it. We got the numbers. We got the data, because I can mitigate everything, and I always bring data to be able to support what I want to do.
So as you say no, you can act very sympathetic to their needs, right?
Yes,
Yeah.
I can typically tell a borrower no, and here's why, and here's how to fix it. Here's why you keep getting told no, and why you keep getting rejected.
And guys, that's the key, is the mystery of banks is you don't really know why. I mean, they could say one thing. What's your appetite? I would ask a bank. What do you want a loan on? What's the credit profile? What's the debt to service ratio you want? And I would reverse engineer that package, and they will still find things because their appetite changed from one month to the next. So we have to figure out, as investors, as business owners, how to communicate with banks and how they view risk. And that's why Bob is here to give us kind of open up the hood and figure out, how do banks really think. So let's talk about the different types of banks. So everybody knows Chase and Bank of America, but what separates those charter banks, those local state banks, from the big boys?
So yeah, banking is kind of broken up in different categories. There's retail banking, and then there's commercial banking. Then you have national banks, regional banks, and community banks. So it all depends on what you're trying to do and kind of the market you're in. I prefer the community banking type of model. That's the bank that my grandfather set up. He was in Houston. I moved to Austin. I didn't want to be in the shadows of my grandfather. I wanted to do my own thing. and the community banking's involved in the community, and they specifically focus on small business stuff. The larger banks do typically large corporate deals, 10, 20, 30, 50, $100 million deals, and then a whole bunch of retail stuff, a lot of transactional to offset some of those large corporate deals.
Sure. Now, in real estate, everybody's scared of taking loans from big banks because for some reason they have way more paperwork, way more documents than community banks do. Why do the big boys, why are they so strict compared to community banks?
So they're underwriting a small business owner like he's $1 billion company.
Understood.
And I break it down to sophisticated borrowers versus unsophisticated borrowers. The sophisticated borrowers are the accountant reviewed or compiled or even audited financials or publicly traded companies, where the small business owner determines how well they're doing by how much money they have in the bank. They don't know how to read a balance sheet or a P&L statement. They just are told, hey, by their bookkeeper or CPA, you had a good year. And it's like, well, I thought so. I've got a couple $100,000 in the bank, but they don't know their numbers. I love Marcus Lemonis of The Profit.
Yeah.
And he mentions, if you don't know your numbers, you don't know your business. And I emphasize to small business owners all the time, you need to understand this stuff,
Right.
because you could be leaving money on the table.
Right.
And as a banker, that's what I'm focusing on. Your story is great, but it's told in the numbers.
Right.
And so I sit down, I collect the package, I look at it. And if there's not a positive trend or there's not a lot of consistency in those numbers, that opens up a lot of questions. And so, and how you structure things, how you've structured the company, who are the owners in the company, what kind of industry you're in. And so I get borrowers that their financials don't balance. Their balance sheet has negative liabilities.
Right.
And it's like, hey, a negative liability is an asset, or a negative asset is a liability.
Right.
Or it doesn't even match from year to year. And so I have to kick it out, and I can't trust those numbers.
You got to trust. It's all about trust and risk. That's the two things you have to understand about banks. Number one, trust. Number two, risk. We have to learn how they view risk. They are the most risk adverse entities around. So we're going to talk about that later. But I went to dinner with this gentleman named Bob last night, and the most fascinating story came up, and I want to talk about when you were in a plane crash.
Yeah. So I am not the typical conservative banker. Hey, the stuffed shirt. Hey, I do everything by the book. I'm an extremist. I'm an extrovert. I like to ride motorcycles, skydive, and I met a gentleman who had a small plane, and we became friends. And we decided we wanted to go from Austin to Gunnison, Colorado, and go to Crested Butte and go whitewater rafting and mountain biking. And he's like, hey, I'm a pilot. You want to fly up there? I'm like, sure. So we flew up there. We had a great week, met a whole bunch of friends. And on the way back, we picked up a friend, and we were flying back from Gunnison, and we took on another passenger. We filled up the plane completely with fuel and had the luggage. And so
What type of plane
it
was
was
it?
a little Cessna 172
The cl-
RG.
The classic Cessna 172. That's supposed to be the safest plane in the air.
Yeah.
It's supposed to be.
It is. The plane saved our lives. The pilot is who nearly killed us. He didn't file a flight plan. He asked the locals how to leave Gunnison. They said take off, circle around the city, then head out towards the mountains. He just took off and immediately headed towards the mountains. We made it over the first mountain, and we did not make it over the second.
So how long after takeoff was the crash?
It was probably about 45 minutes after takeoff.
45 minutes.
Because when you initially take off, especially when I think we're about 8 or 10,000 feet. It's very thin air, and so we're moving really slow. Our climb rate is really small. But I'm looking at our climb rate, at our speed, our altimeter, and I'm kind of looking at the ground and looking at him. I kind of have a general idea because of my skydiving background. And so I'm like, wow, we're not climbing very much. And then we come to the next mountain, we get a big updraft. And it's like, whoo. Well, after a big updraft, you get a big downdraft. And so all of a sudden we start pushed down, and I can see him trying to pull up, and it's like, hey, we're losing altitude, we're getting closer and closer. And I literally lean back, close my eyes, cross my arms, and just relax
Wow.
because I knew we were about to crash.
That's amazing. So how long before the crash did you know? 2 minutes, 4 minutes?
I want to say it was about 2, 3 minutes before we crashed that I was just like, we're not going to be able to get out of this because we were too heavy and we didn't have enough power and we were too close. And it just, with all that weight of the fuel and that additional passenger and the luggage, it just, I mean, essentially the NTSB rated it pilot error. And so we went from 100 miles an hour to zero in less than 100 feet. We pancaked. All three of us got compression fractures.
Wow.
When I opened up the door, because we're pretty much already on the ground. In the small planes, the fuel is stored in the
Wings.
in the wings. So I open up the door and fuel is spewing out, and the guy behind me can't get out unless I get out. So he has to push the seat forward, and so I have to get out, and I just kind of get on my hands and knees, and I go to stand up, and that's when my ankle gives. I fall a little bit, and he's like, "Hey, come get me, come get me." And I was like, "Look, my ankle's broken, my back's killing me. Give me a second." And
Give me a second.
yeah,
I'd be screaming my head off.
and eventually I realized, I can't move. There's something wrong with my back, and he's stuck in the plane, and there's fuel leaking in the plane. I feel horrible for him.
Wow.
The pilot gets out. Of course, the pilot turned everything off, so there's zero electronics going on. But fortunately, after about 4 hours, he could finally lift his arm, and he had a cell phone. He got a signal, called 911. They sent out the rescue plane.
Wow.
They air ambulance the other two guys out. But when the rescue crew showed up, I was sitting up talking to them. I was behaving significantly better than they were, but ultimately I was hurt worse than they were. But I have a real high pay tolerance. So they put me on a backboard, put me in the back of a truck, and drove me down the mountain.
Wow.
And so I was in traction for pretty much about 4 or 5 months. I have four fused vertebrae in the middle of my back, two 8-inch steel rods, and then 8 hooks holding it into place.
So they had to put Humpty Dumpty back together again.
Yes, they did.
Holy cow.
And
So
I got 2 screws in my left ankle too.
Man, that's incredible. So yeah, again, bankers are tough group of people, I guess. I've never met a plane crash survivor before, and I'm so fascinated. Sometimes I listen to the pilots talking to the towers. It's on YouTube. It's fascinating what they're going through. But I can't imagine for 2 or 3 minutes. Okay, so the plane get this big updraft, and there's all these mountains. And then what happens? It's struggling to maintain altitude.
So it then starts, it's getting the updraft, and then as soon as you get the updraft, you get the downdraft, and so it's getting pushed down, and he's trying to pull up, but we're too heavy and too underpowered to be able to pull up.
So the mountain's right here, updraft comes, and then downdraft, and you just feel the plane struggling.
Yeah. So we literally pancake and slide.
Whew.
Yeah.
And then how many hours were you there?
4 hours.
4 hours
Yeah.
of complete silence.
Yeah.
Nothing but birds chirping and backs broken.
Yep.
That was poetic.
Genius.
Well, that is so, man, that's awesome. Now, my 2 biggest fears, and I'm a full disclosure guy, is plane crashes and shark attacks. And then this gentleman tells me he also dives with sharks. So we have Bob the banker, who's been in a plane crash and dives with sharks. Tell me that shark story again.
So
With the red eyes,
Yeah. So a year, well, it was probably about 6 months after I got well. I went back to work, and a buddy of mine moves to Sydney, Australia, a guy I've known since the 6th grade. And I was like, "Oh my God, I want to come visit you." And he's like, "Sure." And so he's like, "I got to coordinate it with my boss." And 6 months later, I go visit him in Sydney because I want to go scuba diving. That was always on my bucket list, was to go scuba diving at the Great Barrier Reef. And so I get certified, and we book a dive trip on the Aggressor. There's this chain of boats that you can book as scuba divers. They're in Costa Rica and the Belize area. They're all over. They're awesome because they're liverboards. And so for 5 days, we lived on this boat off of Cairns, Australia, and did 4 to 5 dives a day. And of course, I'm spoiled because this is literally my first diving trip. I'm in the Great Barrier Reef. I mean, it's like diving in an aquarium, every color of coral that you can imagine. Well, I get introduced to night diving. And I love night diving because it's serene. It is pitch black. you have a light, they call it a torch, and so you can only see what's right in front of you, but it's like swimming in space, that there you can't see anything above you, behind you, below you. You can only see what's right next to you, and you can just hear the and all the fish coming out
Wow.
eating at night. And we're told by the dive master, hey, if you ever see red eyes, that's a shark. They're coming, they're curious, they hunt a lot at night because that's when the fish come out because they're eating.
What makes their eyes red versus other fish?
That I don't know. I just kind of like calculus. I just accepted it.
The blood from the last human they ate?
Maybe of just, hey, trying to put fear in our eyes. They just
It works.
It works. And so I'm with my buddy, and we're diving, and we're swimming back to the boat, and the boat's probably maybe 50, 100 feet away. And that's, let's just put that at 12 o'clock. And at about 9 or 10 o'clock, about 50 feet away, is red eyes. And so I could tell there's a shark, and the shark's essentially between the boat and us. And I look at my buddy, and I'm like, hey, I do the little symbol of, hey, there's a shark. And he's like, yeah, I see it. And then I look at my buddy, and he's got a bloody nose
Oh
because
my
he's
gosh.
just getting over a cold.
Blood in the water.
And when you come up, it releases the pressure, because when you go down, each 30 feet is an atmosphere. So when you come up, it releases that. And so now all of a sudden the capillaries have released. He's got a bloody nose, and I'm like, oh my God, there's a shark. We don't know what kind of shark, and it's between essentially us and the boat, and my buddy's bleeding. And the joke is, you don't have to outswim a shark, you just got to outswim your buddy.
That's
and
right.
so I was like, hey, let's go to the boat. And I made sure I swam a little bit quicker than my buddy. I love him to death. He's still a friend of mine, but it's one of those of, hey, eat or be eaten. And
That's
I was not going to be eaten.
Survival of the fittest.
Yeah.
And as a side note, did you mention this was your first dive trip after the plane crash?
That was my first dive trip ever.
Ever? Was it after the plane crash?
It was after the plane crash, because after the plane crash, I wanted to do that. And so it's one of those, hey, I got to live. So that was one of many things I had on my list. And I do the carpe diem, baby. I live life to its fullest as often as I can.
That's amazing. I mean, once you see death twice like that, it just has a whole new meaning, I'm sure.
Yeah, I'm
Life
so
is
crazy
short.
that one of my bucket list items is to do a night dive in a shark cage with great whites in San Francisco, so that you don't see them coming up, that they just bang. But I haven't been able to do that yet.
So these red eyes, they look like little laser pointers, or is it just kind of a dim red?
They're pretty red, because it especially with the reflection that when you finally catch them with your torch, they're pretty distinctive, because regular fish, it's kind of silvery and you can see them, but the sharks blend in so well with the water at night, with the way that they're designed. You really see the eyes first, and then you can see what they are, but you can't tell how big they are or what kind they are. You just see red eyes.
So life lesson, everybody. After you get in your plane crash, the first thing you need to do is go shark diving. And then when you go shark diving, don't do it normal, do it at night so you can't see anything. Bring a light so in case there's sharks, you can see their red eyes. And if you have a buddy with you, swim faster to the boat.
Correct.
Good. Let's get back to banking, shall
Yeah,
we?
Yes.
The challenge that I have, and I think a lot of business owners have, is balancing your tax liability with making banks happy,
Yes.
right? Because banks love income, but so does the IRS, correct?
Correct.
So there's always this catch-22. You can pay a bunch of taxes and show a bunch of income, but then banks will love you. But if you want to pay less taxes, banks won't love you as much.
Correct.
So how does one balance that? Like when we go, it's going to war. And we're not going to war with banks. We're going to war with the bank's adverse risk methodology, right? So we got to figure out, using Section 179, I'll explain that in a second, but Section 179 add backs, that usually helped me quite a bit, reducing the income, but also making banks happy. But as we spoke about, some banks don't like too many add backs. Let's explain what an add back is, which is a very important point.
Sure. So, do you want my short answer or you
Yes.
want my long answer? Okay. cash flow is the number one criteria of the 5 C's of credit.
Okay.
That the ability to repay is what regulators, especially after 2008, 2009, said. We don't care about the asset, that's important, but we've got to make sure these people can pay us back.
Let's tell them about the 5 C's of credit.
So,
There's couch, and then what are the other 5?
the couch, your comedy,
Yeah.
your commitment. No,
Yes,
it's
yes.
cash flow, capital, collateral, character, and conditions.
Okay, so let's define cash flow for those who don't know what cash flow is. Cash flow means you take in more income than goes out.
That's part of the calculation. So the revenue minus expenses equals net income plus add backs.
Plus add backs.
And then the add backs that you add back are, if we're refinancing any debt, you add back that interest. You add back any non-cash items such as depreciation and amortization,
Okay.
and then any non-recurring expenses.
Right at this moment, everybody's listening's heads are spinning, right? Because these are a lot of big words. So let's break it down real simple. Let's pretend that you're a real estate investor. We'll explain add backs. And let's say you made $1 million for the year in ordinary income. Now, ordinary income would be a real estate commission, you sold a product, whatever. That's ordinary income. So if you had $1 million of income, you would owe $350,000 or so, don't quote me on that, to the IRS, right? But if you went and bought an apartment building is multifamily, which the IRS, and again, I'm not a CPA, so full disclosure, check with your tax advisors, but you're supposed to be able to depreciate that over the next 27 and a half years because it's multifamily and not office space. So what does that mean? Depreciation over 27 and a half years. This is a lot of advanced stuff, so I'm trying to keep it simple. Whatever you paid for the property is your cost basis. So they're going to allow you to take, let's pretend you bought a $5 million apartment building. You'll take $5 million and divide it over 27 and a half years if that's your cost basis. So can somebody calculate that for me? What's 5 million divided by 27 and a half? And what that's going to allow you to do is create a deduction because you're accelerating your depreciation on that asset, meaning it's supposed to go down in value in the eyes of the tax authorities, and that will give you a deduction off your ordinary income. What's the number? 181. Okay, so let's say you made $1 million in income, but you went and purchased this apartment building and you used bank financing. The first year you're going to be able to take, and again, check with your CPA, I'm not an accountant, $181,000 average deduction, which just brought your ordinary income from $1 million to say $800,000. If you're at a 35% tax rate, that just saved you 70 grand in taxes. And then what an add back is, because that's depreciation, the bank will say, okay, you depreciated that, so we're going to add that back to your income for bank qualification purposes.
Correct.
Correct? Okay.
And recently, I think it was back in 2014-15, there's a lot of capital expenditures that the IRS wanted borrowers to improve properties, but a lot of them can be capitalized where you can write them off right then and there. And so roofs, HVAC, things of that where, hey, you're now extending the useful life. But if you want to write off that, probably an apartment complex, $200,000, where that's an expense, but you're only buying that roof once.
Right.
And so you can write it off, reduce that, so that it goes from $1 million to $800,000 to now $600,000.
Correct.
And so, but I know that that's a non-recurring expense. You're not going to buy a roof every year.
Correct.
You went and put in doors. You remodeled this stuff. You spent $300,000-$400,000, and same thing with commissions. You paid a broker maybe $200,000 in commissions. I can add that back as well because you're not going to be paying those commissions every single year.
Right. And what happens if you don't play this game right, guys? You made that $1 million and you're paying $350,000 in tax just to make banks happy. Well, his 6% rate is actually 13% because you didn't play the tax strategy correct, right?
Yeah. And you had asked what's the best strategy. You really need to start planning about 3 years ahead because I'm going to go back at least 2, if not 3 years. And I hate this model in banking.
Is it really 3 years now?
It depends on what kind of loan you want to get. On the SBA side, it's 3 years. On the conventional side, it's 2. We're
Got it.
trying to look at trend analysis, which doesn't make sense to me, but it's just that's the formula in banking of if you would have bought this 3 years ago, could you have afforded it? But 3 years ago, you're like, my business wasn't as good as it was
Right.
last year. Now it's great. I've outgrown my space. I'm making good money. Now let's buy it.
Right.
And so,
Who cares about 3 years ago? But that's how banks think, guys.
correct.
That's why you have to understand your battle plan. Let's get back to those 5 C's. We just went cash flow. What was the second one?
Cash flow. I would consider either collateral or character the next two most important. So collateral, what are you buying?
I'll tell you an interesting story. This is so funny. I was talking with the banker, and I gave him all my documents. But I'm kind of I can be sometimes not friendly to bankers because of frustration. So she literally, for that character part, she asked me to write a letter explaining what my values were to present to the board of directors. And I'm like, what do you want me to do? Do you want to get my pastor at the church to endorse me? Do I need to kneel at the altar every Sunday? What difference does that make? But that's how silly some bankers can be. I literally had to write a letter saying what I'm into, what my character is, after I demonstrated incredibly strong financials.
Yeah, see, I consider character essentially your experience, your expertise in the industry, and then also your net worth and kind of your ability to take care of your own personal affairs. Is your credit good? Are you financially sound on that end? Because initially, when you're doing the loan, you're looking at the project by itself. And I always break it out into 3 different categories: the project by itself, then the business behind the project that's going to own it, and then the people behind the business that are running the business and are going to own the project. And so you really have 3 different buckets that you're underwriting. That I look at the property by itself, then I look at the business that you own that you've been running, and then the owners behind the business. And so there's multiple layers. And it's pretty simple when you have one owner and one business and one property. But a lot of times you have multiple owners with multiple businesses. And so it becomes this Pandora box that I have to collect 2, if not 3 years worth of tax returns and financial statements and bank statements and their debt schedules. And it just goes on and on and on. And I'm a former underwriter and credit manager. And so right now, the regulators, but it's been like this for a while. It really started about 2008 and 9. They don't want any stone unturned. They don't want any hole. I've got to plug everything, no matter how mundane and small it is. I mean, like you said, that 200 that you spent 3 years ago that's unaccounted for. I mean, it's plugging all that stuff and getting all that verification that it's just,
Right.
that's what takes so long.
And that was the second C, which is character or collateral, correct?
We were speaking of character that you mentioned. The collateral is, what are you buying? Are you buying a single family residence as an investment property? Are you buying a retail center?
That's the third C.
Yeah, that's the third C.
Got it.
Yeah.
Okay. And to give these banks some credit, because we don't want to bash bankers, even though it's kind of an interesting show. They have what's called these regulators, right? So a bank could love the deal, but if your criteria doesn't fit their credit policy, they're going to get slapped on the wrist from the banking regulators, correct?
Yeah, essentially the regulators are the referees, essentially the principals of the industry. You've got the teachers or the actual people participating out there that are doing all this stuff. But if you do anything wrong, you get slapped by the regulators, they can grind your business to a halt, shut down the bank, partially fine the board of directors, the owners of the bank.
Right.
I mean, make your life a living hell.
And that's why banks operate the way that they do. That's why they're so risk adverse, is because they have this police force or regulators, which is a good thing. It allows banks
Yes.
not to go cavalier. And I learned something interesting from you last night, is that the regulators make sure you enforce your own credit policy, correct?
Correct. They want to make sure that when you get your original charter or you've been operating and update your credit policy, it is sound business operations, that you're making decisions based upon rules that make sense not only in your industry but for your area.
That reminds me of that movie Yes Man with Jim Carrey. Have you ever seen
Oh yeah,
that? Where he's given the Ducati loan, and then what are those popsicles made out of celebrities, right? That's what they're trying to prevent you from doing in these bank regulators. So there are more aggressive banks and there are more conservative banks, but that's based on their credit policy. So these regulators enforce the credit policy. So if you're going to be aggressive, you can't be more aggressive than you state in your credit policy.
correct. Because when you go outside of credit policy, it's an exception, and you have to be able to justify that exception. And typically, on an annual basis, the regulators come in and they start getting a sampling, and then they ask for your exceptions report. And so anything that's on that exception report that's outside of policy, they're going to scrutinize, essentially audit that specific file. And so every deal that I do, I have to be able to be prepared to open up the whole file and explain anything like I'm in front of a jury, a judge.
Basically, it's what you are.
It is, it is. And so what it comes down to, when you mentioned risk, every banker looks at every deal as it's going to go wrong, and we're going to be in front of a judge and jury, and are they going to find it in our favor that we made a sound business decision and weren't predatory lenders, and we didn't violate any of our own credit policies as well as regulatory policies.
Right.
And if your hair is out of place on any one of those things, you're going to lose.
Understood. So that's why banks operate the way that they do. This is very enlightening, because even though they love you, they love your business, if your loan doesn't fit their credit policy and you go bad on that loan, they could lose their entire charter. It's really high stakes. So you have to balance your battle plan of how to make the banks happy, but also the regulators happy, fit within their credit policy. So before we go on to that, let's finish these 5 C's. So we had
Cash flow, character, collateral, capital.
Capital. Let's talk about that.
Capital is your liquidity. How much money you have in the bank, personal, business, what's in your brokerage account, savings accounts.
Now, I've had arguments with bankers on this capital issue, right?
Yes.
They won't tell me, how much capital do you really want? What's enough? I would say, like, I'll give you an example. Like years ago, again, I was talking probably to that same banker, and I'm like, how much capital do you want? I said, if I don't make another dollar, it'll be 15 years before I run out of money. Is that enough? How much do you want? Do you want 30 years of capitalization? So how do you really solve that? They won't actually tell you how many months of reserves they want.
So what's ironic is in the past about 10, 15 years, I've started defining that because I too hate arbitrary answers. I had a business coach one time, and I loved her to death. Unfortunately, she passed away, but she told me life happens in specifics, not in generalities. And what you mentioned was a generality that, hey, I want you to have good liquidity. But then you're like, what is good liquidity? Can you define that for me? And we're not given a specific definition. And I go back to my president, CEO, and board of, hey, what is a good amount of liquidity do we need to have to get y'all to feel comfortable? To the regulators, what is a good amount of liquidity? And they're just like, enough.
That's ridiculous.
And it drives me nuts, because when I say, hey, I want a deposit relationship, I want you to bring over your accounts, I'm a small bank. I know you're not going to bring over everything. So I typically define it based upon compensating balances, 3 to 5% of the total loan amount. And so I like to have at least 2 years worth of payments in the bank. That's wonderful, but that can substantially hinder your ability to operate, because you as a small business owner, you want to invest that money. You want it to be active. I considered that deposit, and so do you as a borrower, dead money that's sitting there earning nothing, because I want you to put it in a non-interest bearing account.
Right.
And so if that's dead money and I'm forcing you to put in there, it's actually detrimental to your business.
This is such a challenge, guys. I've been through it. Banker after banker after banker trying to crack the code, and I consider myself somewhat intelligent dude, right? I'm very good at figuring out and solving problems, and banking's been such a mystery because of these things, these arbitraries. And that 2 years capital, having that, well, if your credit was slightly off, well, that's going to trump out your capitalization. So let's talk about the rest of these 5 C's then. So we had capital, and what's the final one?
The conditions, the market conditions in which you're operating, the industry that you're in, and where you're actually operating your business.
So here's what it's like, guys. This is a good metaphor. Let's take this room that we're in right now. And bankers, it's all about attitude, as it in life as well. It's all about attitude. And if we walk into the studio and we have the wrong attitude, we can say, oh, these cords should be, taped under the table, and that's a terrible color cup, and these microphones are, too loud, right? So whatever you're going into the room, you're going to pick what you want to support your decision. So if banks don't have an appetite for your project, it doesn't matter what the 5 C's are. They're going to go into that room and they're going to say, we don't like this component.
100%.
So how do you beat that?
So that's why I had my own commercial loan brokerage business for 10 years, because I was referring out 2/3 of the business that I was bringing in, and it was good business. That, believe it or not, this is why there's so many banks out there. Most banks like about 5 to 7 loans. They're really good at 5 to 7 products. So it doesn't matter how good you are. If you're that 8th product, they can't touch you.
Understood.
If you're not if you're a land developer and you're awesome and you want to buy some land and they don't do that, it doesn't matter how strong you are. If you're a church or a nonprofit and you want to do it, doesn't matter how strong. If you're an investor, there's certain banks that only do owner-occupied stuff and licensed professionals. They don't want to do any passive income type of properties. It doesn't matter how strong you are.
So let's help the audience. How do we figure this out? So I've tried to overcome this by talking with the head of the banking division first and said, sir, I understand the game. What is your appetite? What are you loaning on right now? What are you weak in? And then I will go out and I will find those deals and deliver them to you. But they won't tell you up front, right? So they make you do this entire loan package almost just to say no to you. How do we get the truth out of bankers so we don't waste our time before we actually start the relationship?
This goes back to what I mentioned to you of the flaw in banking. Right now, especially in the past 10 to 15 years, the majority of bankers are glorified salespeople.
True.
They're just all about the numbers. They have zero underwriting background. They really don't know what the bank likes or doesn't like. They're just throwing everything against the wall. And so if it sounds good, if it looks good, if it's a large enough deal, they're going to say, yeah, and throw it against the wall and move on and let somebody else determine, is it a good deal or not? And that's where it's so frustrating to me that I have that credit background. And so I will actually do back of the neck and initial underwriting to make sure you comply with all those 5 C's. And typically I want 4 of the 5 to be there. You can have one weakness and then we can mitigate that one weakness. But if you have 5 out of 5, you're within my credit policy. Regulation allows it. We have availability in my credit bucket. I should be able to do that.
You should be.
And as of today, we're pretty much in a recession. However the White House wants to define it right now is irrelevant. We're in a recession.
Sure. That's an opinion, folks.
Yes. And so it's the appetite of our bank that even though I have availability, if we're not going to do it out of fear, then I'm not going to do it. I have an expression: you can't have a logical conversation with an illogical person.
Totally true. Anybody who's dated in life can attest to that.
And banks, specifically decision makers in banking, are very emotional. They're fear oriented. They're risk adverse. And so they're thinking, hey, this is a little outside the box. I don't like the location of the property. I don't like the look of the property. I don't like how this person's kind of been all over the place.
It's the attitude in the room, right?
And
They'll find it.
They can pick the most arbitrary reason. And even though on paper everything looks good, the cash flow is great, the loan to value is great, you have great experience, okay. You got good look, and so
we got to solve this, man.
And so that's where having that true relationship with a banker, and specifically a banker that understands the policy of do we really have this appetite? Because I have to pick up the phone and call the decision maker and go, hey, I talked to this guy Jason today. He's got this great opportunity. And here's where it is. Here's what he's trying to do. Here are the basic terms. Here's his background. It's like, that sounds good. Yes, let's move forward. And as long as you have told me the truth when I underwrite everything and we're able to validate all the numbers, I should be able to get you approved.
Should.
Yes.
Yeah, it's ridiculous.
And what happens is it's kind of like in just general life, you're only as good as your last deal.
True.
And even though your deal is good, if somebody else did a similar deal and it went bad, now all of a sudden we've got a bad apple.
You know why I'm so frustrated with it? I'll give you another example. I did all of that. I got a great bank package, millions of dollars worth of credit lines. Everything was going great. And then all of a sudden, dun dun dun, the bank gets bought.
Yep.
New management comes in.
Yep.
Everything changed.
Yep.
You know, and like my title people right now, they quit and left and they went and started a new title company. Like, what lasts today? It's like this constant flux of change. And, you know, as real estate investors out there, as people who need credit because other people's money, you have to have it. You'll never scale. We have to crack this code. And that's why I really appreciate you being on this show, Bob the Banker, to figure this out. So here's an interesting business idea. Would this work? If we created a platform where all banks kind of joined and we put those buckets in this platform, so it's like this data table of what banks have appetites at any given moment for any given product, would they even be able to tell us? Imagine that, a platform you just went to. Okay, I have a trailer park that I want to finance. Let's spin the wheel and see who's got an appetite before we waste our time. Would that even be possible?
So that was essentially my loan brokerage business that I had, because I would put out every 2 weeks a pipeline report of what I'd closed and what I was looking at. And I was working with about 500 lenders across the country. And that's what allowed me, like I said, there's 5 to 7 products that each bank wants to do. And I made sure that the majority of the deals I was looking at, if I didn't have a bank that was doing that product, I found a bank. So that 90 to almost 100% of the deals that were viable deals, that's key, a viable, realistic request,
Sure.
that I had a bank to be able to do it. And so I essentially created a platform that allowed banks to bid on my deals, and I would price them appropriately, and I would have pricing all over the place, but because of my background, I did risk-based pricing.
Right.
I made sure it was appropriate. And so whatever bank, they had 2 criteria: came to the plate first and could give me as close to terms and conditions. That's who we went with.
Right.
But there's really not platforms out there that open it up, because I see another bank as my competition, a normal banker sees another bank as their competition, and I don't, because my friends work at these other places.
Sure.
If I can't do it, I want to make sure I can introduce you to somebody who can.
Is that information secretive to banks, or can they say, look, I have an appetite, my credit bucket's weak over here, I'm looking to loan on these type of projects? Would they even be able to confess that?
They could, but they don't.
They don't.
They
won't.
don't. The
Kill
ego.
that business idea. It's gone.
Yeah, the ego that gets in place of what they're in fear of, it's crazy to me, because I believe that we're all in this together, especially as a community banker. I want the adage of a rising tide raises all ships.
Sure.
I want to make sure the community is successful, that all community banks are successful, all other banks and credit unions are successful.
Sure.
And banks hate credit unions, but credit unions serve a service. They provide a product that I can't do. And so if I can't do it and I know a credit union that can, why not work with them?
Sure.
That if
Collaborate.
If it's one of those, and what's great is this is part of the business model that I built, is if I send you a deal that I know fits your credit bucket, I expect you to send me a deal in the future, because you're like, great, send it my way. And I'm like, well, hold on. Are you going to send me what's some of the deals that you've passed on recently that you can't do?
That's a good question.
And so I actually have a business model that I chase the sources, not the leads. I learned this from a financial advisor friend of mine, that I go where the deals are. So when it comes to doing stuff, networking is not the most effective way of getting business. Knocking on doors is not the most effective way. Calling other bankers that have bricks and mortars and spend hundreds of millions of dollars on marketing budgets that people are going to left and right, yet it's that 8th deal that's outside their credit bucket that's a viable deal that they can send my way.
Get the fallout.
Yeah, and
That's
so
great.
especially as a smaller community banker, it's a real effective use of my time and energy. So my decision makers are like, well, what's wrong with the deal? Why did they pass on it? And sometimes there's nothing wrong with the deal. They don't do that type of loan.
Right, and they won't tell you until after 10,000 paper cuts.
They've got a full package. They've
That's
got
amazing.
Yeah.
All right, so the theme of this is loan officers, or the people you talk to at the bank to get a loan. Those are salespeople for the most part. So they're the start, and underwriters are the stop, which
Yes.
is a neurotic relationship. It's like almost like a husband and wife.
Yeah.
Let's go on vacation. Let's not go on vacation, right? It's just what happens, right? So let's talk about underwriters. And the worst word that I hate in banking is layers, right? So what is a layer? Let me explain what I think a layer is, because it's so frustrating. There's two types of government loans. Well, there's several, but Fannie and Freddie are the ones who insure or fund most of the real estate in the residential realm right
In the
now.
residential world, yes.
And they have certain criteria that's totally public knowledge. So you can go on and say Fannie Mae guidelines. You'll see 1 through 4 units and commercial and all the criteria. And you could fit yourself into that box perfectly and take it to a bank and say, I got them, right? And then they're going to say, well, we have an extra layer where it doesn't work for us. So can you explain what layering is for banks?
Essentially, the layer is that credit policy of, hey, like the bank that I'm at right now, our credit policy is stricter than the government guidelines. Government guidelines allow us on certain properties to do a 25-year amortization or up to 85% loan to value. We do a 20-year amortization and 80% loan to value.
Okay, so now we've defined layers. It's an extra thing that a bank will just add to mitigate the risk even further than the credit policies of, say, Fannie or Freddie Mac,
Correct.
right? Okay.
Yeah.
So,
You've got federal guidelines, and then you've got the actual banking guidelines or credit policy. That's that additional layer.
Right.
And then there's another layer on top of that of how do I interpret those guidelines? Like I'm dealing with an underwriter right now, our chief credit officer, and he likes to exclude all capital gains.
what?
All capital gains. He considers all capital gains non-recurring, even if you're a developer that year after year after year, you've had capital gains, capital gains, capital gains.
And Elon Musk is out.
Correct. And so I try to show trend analysis. I deal with logic. I was like, if it's non-recurring, then they didn't have it the previous year, correct? Absolutely. Okay. Did they have capital gains the previous year? Yes, they did. So therefore it's recurring. Well, technically, no. I was like, well, yes. If they have it 2 years or more, then it's something that's part of their business model.
How frustrating.
And so that's where I'll go back and be like, hey, or the non-recurring expenses, that some of the add backs, that if they're significant, that sets off kind of a red flag, a lot of bells and whistles. I love non-recurring. That's one of the reasons why I went to graduate school and got my tax accounting and finance background, for my ability to be able to look at those financial statements and find the numbers to be able to make the numbers work and it be viable, that it follows general accepted accounting principles, GAAP, and is appropriate by
Gap's a store at the mall.
well, those are genes. That's GAP, not GAAP.
Got
So
it.
yeah, that's
Thank
okay. You're a simpleton. It's
Perfect, perfect. Thank you.
But that's where I laugh when a regulator, a board, or a decision maker pushes back on a deal of mine, because I'm like, it checks all the boxes.
Let me tell you something else that really bothers me. There's a lot. I'm just going to.
I can tell.
I'm just going to give you the surface.
Yeah.
So, when we were buying residential, single-family residence, right? I had this argument with several banks, and they want to do those 20-year amortizations.
Yes.
Now, for the audience, most loans are 30-year loans, right?
Yes.
And that means the payment goes down. But banks like to do 20-year amortizations versus 30 when it's investment-type real estate. And here's why that makes absolutely no sense. In rental real estate, cash flow is king, right? So you have this thing called debt service ratio, which means the income you're bringing in is a certain multiple of the expenses. That's a debt service ratio. Most banks operate in a 1.2, 1.3 range is what they're safe with. Well, guess what? If you have a rental property that's $1,500 in rent and your expenses are $500 for taxes and insurance, now we have to add the financing. Well, making a shorter amortization is going to increase that payment, therefore ruining your debt to service ratio. So where does the risk change between somebody paying 800 to the bank or 900? So I've had this argument with several banks, and I said, look, if it's a game of risk, let's lower the loan to value by 3 or 4 points, which then makes you accelerate the amortization out of the gate. And that way I can still have the cash flow. But they won't do that. So imagine the criteria is an 80% loan to value on the single family residence, right? And they want a 20-year AM. So what they're doing is trying to mitigate their risk by getting it paid off at an accelerated rate versus 30-year, correct?
Yes.
Okay. And I said to these banks, several banks, I said, okay, no problem. Let's just make it 75% LTV because your buy down in the next 3 years on a 20-year is probably about 3 or 4% equity position. I'm going to accelerate that for you. Let's do 75% and let's keep the payments low at a 30-year AM. Everyone said no. Can you explain the methodology of that when I totally solved their risk mitigation?
Yeah, I have this discussion all the time with my at my current bank and my in my credit policy because we do not have 25-year AMs. And I define it as, hey, if in the appraisal, because I leave it up to somebody else, not me or the borrower to define it, in the appraisal, if they put the useful life of the property of 25 or 30 years, that means, because that's essentially what the amortization is, what's the useful life left? And then if it's new construction, kind of same thing. Of hey, if it's new construction, I should be able to do 25, 30-year AM.
But that's such a silly thing because nobody ever keeps a house for 25 years. You'll never see the end of the useful life.
Yes. So it's one of those when you do an owner occupied, whether it's commercial or residential, you're going to take care of it a lot better. And you mentioned
Investment.
and the investment stuff. The investment stuff, you're not as vested on taking care of something if you don't live there. Somebody else lives there. They're going to cause a lot more wear and tear on the floors, the toilets, the outside, the upkeep, just the overall stuff. So the useful life is actually going to be reduced on the investment side.
Is that the real reason?
That is the real reason. It is. It doesn't last as long if it belongs to somebody else. It's like, hey, you've had this great T-shirt that you've had forever in your entire life, and you hand it to your kid, and in one season they trash it and they throw it away. Where it's lasted for you for 20 years, and you give it to your kid, they're not as vested.
I get it.
And it just when you don't own it, you don't use it, you didn't buy it, build it. You're not as partially vested in it. It's just not going to last as long.
Right. And then I had the other argument, and that's the last thing I'll say about it, is interest only versus principal and interest. A lot of banks hate doing interest only. And again, it's the same argument. Let me accelerate your principal buy down by doing a lower LTV, and let's just do interest only. And the reason investors want to do that is we can deduct every dollar of interest. We cannot deduct a principal buy down. So we want to maximize our tax strategy by just having the payment be 100% deductible, not another 20% on top that's not deductible and also losing cash flow. I hope the audience understood that. So why is interest only such a bad thing if you can accelerate the LTV by just doing a lower LTV with interest only?
So that's where it comes down to regulation. The regulators and just banks in general want you to reduce your risk by making principal payments. So therefore, you're building up equity in the deal.
I understand.
That allows you to be vested, that you have skin in the game. When you're just paying interest, you're really just buying time. You're not actually investing in the project.
Right, but if their credit policy says they'll do 75 LTV on this particular loan, and I say, well, let's just do 70, but let's make it interest only for 3 years, I've accelerated their risk. I've de-risked the asset by making it a lower LTV out of the gate. They don't have to wait for that buy down to 70. Is there any way to get them to understand that?
So that goes back to you're having a logical conversation with an illogical person.
Thank you.
That I remember having this discussion with a chief credit officer at another bank, and it was on your deal, the difference between 70 and 75%. And the policy was 24 months interest only, and you wanted 3 years interest only.
I
And
always
so
want more than I gain. That's just me. Sorry.
you got to ask for more. You
Yep.
got to ask for more.
That's why I have such a beautiful wife.
Yeah, yeah. And why did you settle? Why did I mean?
She settled.
Yeah, yeah. I'm asking her. Yeah, yeah, yeah. So, and you're right. If I look at a year's worth of payments, the difference between 24 months and 36 months, how much principal can you pay down in a year if you did P&I payments? And it's about 3 or 4%. And so with you bringing 5% more to the table, 70% loan to value on a 3-year interest only actually lowers my risk versus 24 months interest only at 75%.
Correct.
And so I was able to justify that argument, and I was able to get it done.
That's why this gentleman's here.
Yeah, and it
But we don't know who he is.
yeah, I don't want. I respect where I am right now. I'm very grateful, but I have to be careful because I don't always speak the most positively because I'm frustrated, just like you with the banking
Sure.
model. That I think there's always ways to improve it, but I don't run the show.
Sure.
It's not my money. I'm not the leader. I'm an entrepreneur that happens to be a banker. So I think like a small business owner and try to come up with ways. I'm a glorified sales guy that just happens to be analytical. And so the people that run it, here is when I raised capital and had a private lending company, I learned this expression that wealthy people think completely differently than normal people. The number one rule for wealthy people, and wealthy people are essentially the people that own banks, are preservation of capital. Do not lose money. No matter what you do, do not lose. I don't need to make a lot more. I've already made a lot of money.
Right.
So they will pass on good deals if there's just some arbitrary reason. You know what? I might lose some money here, or I'm not as familiar with this business model, or I don't like this area, or man, this guy's kind of been all over the place. He's had several different jobs, or he was divorced, or hey, he had a business partner 3 years ago sue him.
Or he's mean.
It's just an arbitrary reason, and they just say, hey, it's not a good fit for us. We're going to pass on the deal.
See, that's so subjective, and we got to figure out our battle plan. So we're going to wrap it up here, and I really appreciate you giving the insights, the secrets of a banker here. But for the listeners who want to create relationships with banks, what is the first step in getting their war game ready, their package? You had mentioned 2 or 3 years of history. Should they focus on 3 years or 2 years?
I always like to say you need to be prepared more than what is needed, because the amount of time it's going to take you to have to go back and get that information or track down your CPA or business attorney and get all those corporate documents and everything, get 3 years worth, get that full package, get all your formation papers, your bylaws, your operating agreements, your current personal and business bank statements. Go and do a quick little credit check on freecredit.com, whatever it might be. Make sure there's no irregularities. Get all your tax returns ready to go.
Now that's a good business, is helping people prepare for future bank relationships, like auditing their financials and say, here's how banks think, let's package it up in that fashion.
And that's kind of what I did when I was a commercial loan broker, even though ultimately people paid me to place their loans.
Right.
The majority of what I did was consulting. I advised them on what was needed. And I win and lose a lot of deals because when somebody comes to me, I send them my list of what I need. And it's about 30 to 35 items. Wow. And they're like, oh my God, this is going to take me forever. But it's everything I need to close. Right. Instead of, get me these 5 items, thank you. Hey, now in order to, looks good, now get me these other 5 or 10 items. And now you're a week or two, and it just drags on and on and on.
So guys, that is the key, is preparation for battle. Every war that's fought, they prepare for years. You're going to need money a year from now, 2 years from now, 3 years from now if your business is growing. Don't make the same mistakes I did and thousands of others, and then start your banking relationship when you actually call them. You have to prepare before you call them. So figure out how banks think. Listen to some of the stuff of this podcast, but do some research online. Go over Fannie Mae guidelines. Think like a banker, because other people's money is so important to scaling your business. You'll never get away from it. You can't pay cash for everything. you'll run out of cash really quick, but the banks have all the cash. And that's probably why they're the way that they are, because they know the golden rule is the man with the gold makes the rules, right?
Absolutely.
Right. So guys, this has been Memoirs of a Secret Banker. We should probably do several of these over time just so people can really understand how to capture a bank's attention, how to make them love you, how to get your financials in order for years before you even talk to the bank. And number one, how to figure out how to play your tax game and making banks happy at the same time, which is the biggest challenge for every small business. So guys, go to timemoneynetwork.com. Set up a 15-minute consultation if you're struggling with anything. We want to know about what's your most pressing issue right now so that you might know what you don't know that you don't know. That was kind of complicated, but you get the point. Go to timemoneynetwork.com. We'll also put a link if you're interested in starting relationships with a bank. You might get to reveal Bob the Banker real identity, okay? So we have a list of different financial institutions that we think we know how they operate. This guy's been one of the best guys I've ever worked with, but right now he's just Bob the Banker to you. But if you want to know, go to timemoneynetwork.com. Any final words?
Yeah, real quick. I'm
Sure.
sorry. You reminded me of a life-changing occurrence that I learned in college, and I watched this cheesy video called "Where There's a Will, There's an A."
Oh.
And I was getting B's and C's, and I couldn't understand why. And essentially, I watched this video, and it came down to presentation. And they're like, look, if you present yourself in a certain way, you get preferential treatment. And they described it as a burger. That if you order a burger and it shows up and it's a thin bun and a really thin piece of meat and wilted lettuce and just kind of gray cheese, you don't even need to take a bite. You're just like, it doesn't look appealing. But if you order a burger and it's this big, thick, glistening bun with a little bit of butter coming off and just crisp lettuce and this thick piece of meat, and it's just glistening and the cheese is vibrant, your mouth is watering before you take a bite. That's a loan package.
That's right.
If you can create a loan package, and that's what I prided myself on, that I put it in a way that a bank, went to the top of the pile, that people were excited to look at it, that they were dropping everything because I was prepared and ready to go. And so if you have a prepared loan package and you have all your information ready to go, I will drop everything, look at your deal, and get it in front of the decision makers as quickly as possible. And that has served me very well. And I will tell you that that is the secret, that you will get preferential treatment, you'll get preferential pricing if you have all your ducks in a row, if you have all your financial information, whether you're getting a home loan, an investment property, commercial property. You are going to move forward in that process a lot better if you have your package ready to go.
Right. Preparation is key. You never get a second chance to make a
First impression.
That's right. And it's sort of like those commercials, the fast food restaurants. The burger never looks like that, does it?
Nope.
It's all glistening and you get all hungry, right? It's all perfect. That's what your loan package should look like, a burger commercial, so that the banks will love you, you'll get other people's money, and make a bunch more millions and add it to the rest of your millions.
They need to be hungry for your business.
That's right. All right. Well, Time and Money Network, Memoirs of a Secret Banker. We love you guys. Thanks for listening. Go to timemoneynetwork.com. We have Bob the Banker, which you might get his real identity if you go out to the website and fill out that form. So thanks so much for being here.
My pleasure.
All right. We'll see you guys later.